Hello and welcome to San Diego Market Watch, where we bring you local, accurate, timely information about the San Diego real estate market every single week. It is November 4th, 2022. If you like this content, please remember to like, share, subscribe, and comment, because that'll keep the information flowing and keep the conversation going. Let's jump right into what has happened since last week in San Diego real estate. And the answer is not a whole lot. The number of homes for sale has remained very steady really since the middle of September. About half of this inventory that's currently on the market has been on the market for more than 30 days. And so that is representative of sellers sort of digging in and not reducing their price anymore, or reducing enough to sell right now today. Some sellers are banking on the fact that things might get a little better between now and the end of the year, which, frankly isn't all that likely. But the number of new listings does continue to decline, although appears to be leveling out at around 500 new listings a week, which isn't really a lot. And so a lot of these new listings are coming and going very quickly if they're priced well, and they are making new comps, which is not necessarily good for these sellers that are kind of sitting on the market and waiting to see what happens. There is sort of a standoff going on right now between sellers and buyers. The number of pending sales fluctuates. It's been going down and now coming back up just a tiny bit. I just don't know if this trend is going to be strong enough to help these sellers that are hanging out on the market right now, but time will tell. So what's driving all of this is interest rates, which did come down a little bit in the past week. Last week's average was 7.08, which was really ugly. It's the first time we've topped 7% since 2002, and the median price in 2002 was far lower, so didn't have nearly the impact back 20 years ago as it does today. 7% interest rates and median price in the mid 800,000s is really not a sustainable market. We're just not going to be able to keep the market going at a strong pace with prices that high and rates that high at the same time. So something really does have to give. I believe at least a partial solution is to get more sellers on board with buying buyers' rates down and get more buyers educated about the rate buy down, because you can buy this down in a lot of cases by 3 points and get it down to 3.95 or somewhere in that range, and that makes things a heck of a lot more affordable. Because at the median price, where rates were back here in March, April, May, from here to here is a swing in terms of payment of around $1,000 a month, depending on how much you're putting down, your loan program, etc. And there hasn't been a corresponding increase in median income or anything like that that would make that more affordable for folks. Slightly more affordable at a 15-year fixed, but that's not for everyone. And then the 5/1 ARM looks nice, and it is nice, although the buyer does have to qualify at the full rate, and so that squeezes a lot of people out of this qualifying box, even though you can get that lower introductory rate. So rates are really driving this thing, and the Fed has signaled they're going to raise things again in December, which is probably going to equal higher mortgage rates yet again, or maybe it won't, depending on what the Fed chairman says. It's not necessarily the amount of the increase that they do to the prime rate that affects mortgage rates, but more what they say, what they signal about what they might do next, and that will affect the treasury market and the stock market, and that is what is going to impact mortgage interest rates more than the prime rate, if that makes sense. So let's keep an eye on that and keep our fingers crossed for lower mortgage rates going into next year, although I do believe they're probably going to get worse before they get better. However, we shall see. So let's go ahead and take a look at median price, which we did last week, hasn't changed. As I mentioned last week, this little uptick here is probably not indicative of a trend going back up. It's more indicative of just a month-over-month number, the median of a bunch of higher-priced sales versus lower-priced ones. And I think the trend is clearly established and will continue down for a little bit longer before it gets better. And again, that really has a heck of a lot to do with interest rates right now. So we will just wait and see what happens next. Thanks for hanging out with me today on San Diego Market Watch. We'll be back again next week with, I believe, the monthly market update, because new numbers are coming out for October. And so that'll be interesting to see where this line actually goes and what the finer detail shows us about the overall San Diego real estate market. So thanks for watching. Have a great weekend, and we will talk to you again very, very soon.